Welcome back to the Tokenize Podcast. Today we're diving a little bit deeper into something that people talk about all the time, but very few actually understand, which is institutional crypto. And as always, the Tokenize team members are here with us. We have Nate and Shakes right here in the chat. We've also talked a
Hello.
bit on the show about
Yo, yo, yo.
institutions and how they're slowly entering crypto. And today we're joined by someone who's working on the infrastructure that's quietly making just that happen. With us is Chris, who is a core member at DeFinity Markets, one of the most interesting institutional grade platforms in crypto right now. And so, Chris, welcome to the podcast. Why don't we kick things off by you introducing yourself? Tell us a little bit about your role at DeFinity.
Yeah, hello, Ed. Listen, great to be on here and to be chatting with you guys. And yeah, look forward to sort of talking a little bit about DeFinity and the broader sort of crypto and Insta ecosystem. Yeah, as you said, my name is Chris. I'm from DeFinity Markets, a co-founder there. And we have been building over the last 3 or 4 years, basically an institutional grade venue for digital assets, which at the moment is predominantly crypto. And my role there is a CFO and risk officer, so I'm very involved in the operations. My background, along like a lot of the other members of the team, is been from TradFi. So, I have spent more than a couple of decades in traditional financial markets and many divisions of very large European banks. So, what happened was a few years ago, one of my colleagues and myself and a couple of people he was working with and our sister company DMA Link, which is a large institutional foreign exchange platform, got together and realized that there was more to crypto and blockchain from an institutional perspective than anyone was really realizing. And we started our journey out to create the inflection point for institutional participants to get into crypto and digital assets, sort of recognizing all the differences and values and benefits that sort of blockchain-based technology brings, but also recognizing some of the legal and regulatory requirements that institutional clients have to adhere to be able to participate in this new and emerging asset class. And that's really been our sort of journey over the last few years. We rolled our sleeves up and we obviously created a token. So we thought the best way to make sure we fully understand how crypto and blockchain works is to actually participate on it, to get in it up to our necks and sometimes over our heads, which we proceeded to do. We created our own token, DEFX, and that was a native ERC token. But during our time with the token, we have also bridged it to BSC, and we're looking at a couple of other potential wrap tokens as well. We've created our own bridges because, as everybody knows, or not knows, but will probably have heard, a lot of the big hacks that have happened in between the crypto layer ones have been through the weaknesses exploited in bridges. Because without the size of community, side and governance, we were concerned that maybe that was sort of a weakness in the exposure. So we created, with some very good members of our community, we created a bridge specifically for ourselves. We've also worked on, obviously being on a DEX, we are currently on MEXC as a sort of centralized exchange. We have been on one or two other exchanges over our time, but not all those exchanges still exist after the crypto winter. So one or two of them went by the wayside.
Yeah.
We learned a lot of lessons, we hope, and we made I'll be honest, we ran through a lot of brick walls that we didn't really realize existed, and learned a little bit about what crypto was really like at the sharp end. And, it's been a massively interesting journey, but I think it also helped us understand what we needed to build in terms of a fit for purpose solution for institutions as well. So it was really about bringing our knowledge of wholesale markets and institutional flow and requirements, from foreign exchange and other asset classes, and marrying that to what crypto and blockchain platforms bring to the party to create that sort of bridge between the two. and the inflection point. And our role in that inflection point is we're not an exchange or anything like that. Our role is to create a venue where financial institutions can come on in a regulatory compliant and credit compliant way, transact with multiple liquidity providers, demonstrating good pricing to them and delivering best execution. So that really is about what we've created, working with a large European investment bank and others sort of coming online. And that really ticks some of the boxes that financial institutions need to adhere to, such as best execution, such as segregation and independence of custody versus trade settlement, and those aspects of regulatory coverage of the ability to offer the service to the financial institutions. So I'll kind of take a breath there, but hopefully that's a super quick skim over what has been 4 or 5 very hard-working years.
Yeah, I mean, it's very, very interesting, right? It's the part where institutions see what's going on in the crypto world, and they see Bitcoin is up how many 1,000%, since the last 10 years, and they want to get in on it, and not just on Bitcoin. They want to get in on DeFi. They want to potentially get in on crypto gaming as well, which is a big thing that we cover over here. But the thing is that they can't do it until there's certain regulatory compliance here, which we do not have. And not just that we don't have it, it's like these crypto projects are very against regulation, which I don't think is the right way to go about it. If we want the big money to come in, we need regulatory compliance. And once we do have that, then more of these institutional investors are going to come in. And that's where I see what you guys are building over at DeFinity is sort of the first step to let these institutions get in on crypto without having, to use something like an ETF, right? Where they can just do it on their own, and you guys are fully regulated, right? If I remember correctly, you're fully regulated in Mauritius and Jersey, right?
Yeah, absolutely right. That's correct. And I mean, you bring out a brilliant point about ETF. So ETF is really just a demonstration of demand by financial institutions. So big asset managers, like the few biggest asset managers in the world, like the BlackRocks, Fidelities, and so on, are big enough and are have fingers in enough pie, shall we say, that they can pretty much dabble in whatever they want through one of their jurisdictions. So they've been able to get into crypto, and Fidelity has a custody service. BlackRock have talked about tokenization of of real world assets, digital assets, and crypto. So they're kind of talking a very good game, but they also recognize that even asset managers with hundreds of billions that under their control, because it's not their money, they have to follow certain rules to be able to invest that money, even in those alternative assets such as crypto. So they want to participate because crypto is big enough now as an asset class that it is a genuine alternative asset. But what they can't do is, because they're looking after, your money, my money, pension funds, etc., they can't take risks with that money. They need to follow certain rules that protect that money from total loss, just to make sure that they are looking after other people's funds and assets in a certain way. So it's those rules that sort of stop them getting in. So the likes of BlackRock and so on have come up with the ETF idea, which because of the regulation means that they can offer some appreciation into the ETF, through the ETF into assets such as Bitcoin. Now, whilst that's a good introduction and demonstrates that there is institutional demand, what it doesn't really do is allow people to actively trade. An ETF, because it sort of charges an annual cost for management of the funds. There are certain rules and restrictions about how you can liquidate, etc. It's not an efficient way to trade. It's not the same as accessing the physical, so the actual token itself. It's a sort of toe in the water, but doesn't really fit the way that most asset managers deal with things. So the demonstration of demand is great, because it shows that there is a pent-up market of people waiting to get into crypto from the institutional perspective. But if anything, it actually increases the frustration that they can't go in and trade it the same way as they would with bonds or with equities or with sort of cash and foreign exchange instruments. So it's a great start point, and it sort of helped legitimize. So it pushed financial institutions off the fence, because they then had a regulator saying, hey, you can buy this in an ETF, which sort of says Bitcoin's not criminal. Yeah, you're allowed to touch it. We're allowing it onto a market. So it provided some legitimacy, but at the same time also demonstrated that the market was still quite immature and needed a little bit more work before everybody could sort of break in fully. And really that's the sort of the puzzle that we have unpicked in DeFinity, is creating that ecosystem where, to give you a very, very brief background, in the financial crisis, a lot of things were centralized. In the global financial crisis, the end of the noughties, the centralization of all these different aspects of a trade being in one place meant that when that entity, that institution, that bank, that sort of venue ran into trouble, it caused problems for everybody else. Now, and bust a lot of holes, to be perfectly blunt, about decentralizing and deconstructing the market for wholesale financial institutions in all the asset classes to individual components with fail-safes and checks and things like credit support, collateralization. So basically remove that central point of failure. Now, if we look at what happened in the crypto markets, as an example, they have come in and the large global exchanges and so on are introducing offerings. They have institutional desks. That's great. But what they've not done is they've not deconstructed the centralization again. So basically, they're offering the same all-in single venue service that financial institutions were offering back in the early noughties. That meant when the financial crisis happened, we ended up in the problems we did. So what we have worked hard to do, and what we see the regulator understanding, is that the move of crypto into financial institutions still has to adhere to the rules, where you can't do everything in one place. You have to split out the roles and responsibilities, because then that protects everybody. So again, our venue, for the large financial institutions, we've got for credit intermediation, which means there's a credit support. So they're facing an investment grade counterparty. Our venue is custody agnostic. So although a lot of the institutional market use sort of fire blocks, we also do a lot of work with Utila, which is a very exciting new wallet custody technology provider. People can choose their own custodian, so they don't have to give you the assets in your exchange first and then run the risk that if something happens to you, and we've seen a few exchanges over the last few years go slightly Pete Tong, what it does is it means that you look after your own assets until the point of trade. And again, with the credit support, it means that when you trade with somebody, you're not taking risk on them as a crypto hedge fund or as a crypto exchange or as a liquidity provider. Actually, you're taking risk against the bank that's sitting on collateral, which is cash or government bonds. So if something happens in that trade, you're not exposed to the person you're actually buying the tokens from. Your credit risk is underwritten by the collateral that supports it. So effectively, you are facing an investment grade counterparty, which is critical for large institutions looking after other people's money. And then, of course, there's a regulatory wraparound to make sure that you have a credible jurisdiction of regulation. We chose Jersey because it's near shore to the UK. We've done a lot of work with the FCA. I think I'm even in an FCA video at some point when they did their first crypto sprint. We've been involved in their policy roundtables, but they've been slightly slower in getting to the party than maybe sort of Europe and maybe now than the accelerating US side. But we chose Jersey because it was very much a funds-focused jurisdiction, and they were quite proactive in the way they were approaching digital assets and crypto. Because we weren't facing directly into retail, again, they were very happy to have us on board because it sort of fitted their profile, and we've worked hard with them to build that up. The Mauritius side comes in as much as the regulation for our smaller cap business and our proof of concept business we undertook with the Mauritius side. And the reason we worked with Mauritius was it wasn't really going to work for the global funds and banks to face into as a jurisdiction. However, for the smaller cap businesses and for our proof of concept and our pre-funded model, it worked perfectly because it was still respectable jurisdiction. It's not grey listed. It gave the people that we were dealing with a good degree of confidence that we were complying with things like AMLD5, which is the European money laundering regulations and so on. So they knew that we were a proper venue, that it was safe from a financial action task force perspective, financial crime perspective to deal with, and that had governance and compliance and oversight. But again, it was ready, it was there at the time. So it was our sort of first start point for our small cap and our proof of concept business. And to be honest, that has been so successful that we're actually sort of keeping that as a subdivision going forward. And bringing all this together, people can only buy and sell crypto if they actually have assets on there to start with. And one of the strengths that we like to believe that we have brought to the market is because of our decade plus in institutional foreign exchange and some of our very large foreign exchange banking partners, we've been able to provide good on-off ramping capability and access to different currencies to a lot of people in the digital asset world that to date have been finding it very, very difficult to access fiat. So, banks and everybody, they know how to deal foreign exchange. On the crypto side, a lot of people, when they generate value on chain, they're happy to trade it. But actually getting on and off chain has proven difficult for a lot of institutions for quite some time. And being able to help to bridge that gap just eases the inflow of value on chain so people can actually invest their TradFi assets into digital assets. And again, that's sort of a key component that a lot of people have sort of missed building out their ecosystem. So, they're either entrenched in the TradFi world or in the crypto world, but actually enabling value transfer between the two is really one of the things that's going to help crypto and other digital assets grow.
Yeah, interesting. So basically, it's like to use an analogy, is sort of like an Amazon marketplace for crypto. So it's not Coinbase 2.0. You are matching buyers with sellers without ever touching the funds. Something along those lines, right?
Yeah, exactly. Very, very kind of very loosely, but that's a great analogy. So Amazon Marketplace is great. Manu, one of my other co-founders, he always uses Amazon Marketplace. I mean, since I'm based in the UK, then I always think of kind of eBay versus Amazon. So to me, Amazon, they own the goods and they sell just to you. But Amazon Marketplace is exactly the same idea. Yeah, exactly. So it's providing a venue whereby you as a purchaser can come along, and then multiple sellers will come along, and we kind of curate those multiple sellers, and you come along to purchase. We curate the multiple sellers, and we facilitate that transaction through our venue and orchestrate the sort of the settlement or the on-off ramping that allows the transaction to take place. So yeah, no, you're absolutely right. And we're even going sort of one step further, this kind of small cap business as well. We're even sort of going one step further. So the cat's a little bit out of the bag, but we have it is an independent entity, but we are now sort of going live in the very near term with Bloomsbury Money, which is effectively for funds and for kind of larger corporates that are dealing in digital assets that are struggling with payment rails and banking rails, because it's quite difficult to get banks to deal with institutions and companies that deal in digital assets and crypto. Then we are standing up Bloomsbury Money, which will be providing accounts and foreign exchange services to institutions that are involved in digital assets as well. So again, we're looking to kind of broaden as an overall offering what we can bring to the market to help grow that market and to help accelerate the adoption of digital assets. So yeah, you're absolutely on point.
Yeah,
just before
I'm wondering though. I was gonna say just that. I was just gonna say I'm wondering now, based on all of this, how do you guys feel about all that's been talked about so far, Nate?
Yeah, I mean, I just wanted to jump in there before we stray too far away from this. But from me as a Canadian citizen, specifically in Ontario, the off-ramp to get crypto into my bank account is a nightmare, to put it bluntly. I used to use Binance all the time, but guess what? That doesn't work here. I used to use Kraken. I used to use whatever. It doesn't work here. I only have one option, and that's ShakePay. And then I have to go through their kind of like elevated fee systems in order to get any kind of my funds out of the chain into my bank account. So I think that what you're developing here with DeFinity to kind of streamline those on and off ramps is just going to be something that's very beneficial for everybody. And hopefully it works in Ontario.
Yeah,
Yeah, but is it for
absolutely. I mean,
retail
to be
though?
clear, it isn't going to be targeted at retail, unfortunately. But
Yeah.
Yeah.
the thing that we are very firm believers in, and this is the way we've kind of created the whole way through. So we create something that works for institutions, big institutions or corporates, so, banks, etc., to facilitate. One of the reasons for doing that is, the reason you can do foreign exchange payments and say Revolut or whatever so quickly is because they go and do all their buying and selling with banks in the background. So the more clunky and the more restricted banks are in delivering a service from a wholesale side, then the more difficult it is for retailers to access those services through their banks. So
Mhm.
our belief is that by enabling the wholesale infrastructure that supports the market itself, that the pass through to the retailer will then accelerate. So there is far more traction and far more ability to offer a good service if the infrastructure that sits behind the scenes at banks isn't creaking so much. And that's one of the exciting things about digital assets, crypto tokenization. And actually, not even related directly to crypto. A lot of people have been talking, for example, about tokenized equities. So one of our strategic partners based in the Middle East is regulated in a lot of sort of Asian and Southeast Asian countries, and their service offering is to be able to deliver, for example, tokenized equities to people who have $10 a month discretionary investment income, for example. So by tokenizing and fractionalizing it, they can offer that service. So the reason they can do that is because the infrastructure that sits behind them is being knitted together to create a more efficient service to enable them to deliver that to the retail side. So although we're not directly for retail, we firmly believe that building the architecture to enable the institutions and the banks and the finance participants that face into the retailers, by building the architecture for them, it enables them to accelerate and to broaden their service offering. And it was the securities services, so an equity custody and services forum that we were at, actually invited by some members of the Banque de France who are working in the Euro CBDC project. And we did a bit of work with them a few years ago, just discussing the market, how it could work, and etc., and a little bit of thought leadership. And one of the things that they actually said was they were seeing the tokenization of assets, so not just crypto, but tokenization of things like equities and so on, is enabling them to provide a more visible, transparent, and personalized service to the retailer. So, rather than a prepackaged fund that you either buy it all or nothing, or you have to buy a share or nothing, they felt that the future the blockchain tokenization was bringing to them was to enable them to provide a more tailored and personally directed service that was passed straight through to the retailers. So the actual retailers could end up deciding what the investment bias of their portfolio was, whether they wanted to invest in anything to do with armaments, whether they didn't, whether they were looking at green tech, whether they weren't. So really a way of providing a very transparent and traceable approach. So your point is absolutely right. It's whilst we don't directly fund straight into the retail side, what we do behind the scenes creates the infrastructure that enables the retail facing banks and participants and providers to give you a better offering faster.
And it provides that legitimacy aspect as well, which I feel is something that crypto is very struggling with. When we see the U.S. president rugging their whole nation,
Yeah.
but it's very interesting. What are your thoughts there so far, Shakes?
I mean, I have quite a few thoughts. Personally, for me being a retail trader, I think number one, in the long term or long run, will there ever be um, an option for retail, traders to to participate, with DeFinity. I think another big thing too, though, is that allowing bigger banks and platforms in crypto, number one, it creates like more stability and liquidity. We're always kind of looking for that, especially as traders, and it offers more of an opportunity because there are tighter spreads and it makes it kind of easier to buy or sell large amounts. But will there be an option for retail traders? I know you said you start with wholesale, right? But what are we looking for in
Yeah.
the future?
Like,
Well,
yeah,
I
let's
think
franchise it, right? Let's get our wholesaler, right? Now let's get our little Etsy crypto shops that pop up. It's like
yeah.
we got grandma. She just knitted this great scarf, and guess what? I tokenized it, and now you can go on grandma's Etsy crypto shop, and now you can actually burn that.
Yeah.
The sky's the limit here.
It's crazy to think that you can tokenize like just any asset. So when you say equity, I mean I'm personally thinking like what if you just want to offer up your car, or what if you want to offer up your house, or you gotta put into change something with your mortgage to to start trading. Coming from like a different perspective, but yeah.
Well, you're not wrong in that. I mean, one of the things that we've spoken to people, so it's a little bit down the line, and it's not part of our kind of our core operating basis. But when you talk about things like that, you could, and this is one of the things that we have discussed with some of the thought leaders, could actually go out there and you could buy a house with your mortgage, for example, but then actually almost kind of crowd fund the equity piece that you owned a certain percentage, but you also allowed other people to participate in your equity. So as the house price appreciated, their investment would rise with equity. So it sort of one helps people make investment into equity house prices rather than just putting into a savings account somewhere and hoping that they accumulate enough to make a deposit. Because at the end of the day, interest rates, if you're looking to buy a house in, I don't know, say central London, interest rates will not reflect price appreciation. Even if you take the current slight downturn in the market, interest rates would not have kept up with house price appreciation and value. So if you were putting your money in a savings account and taking an interest rate, the chances of you being able to grow your deposit faster than your deposit need grows ahead of you with the house price growing up is slim. However, if you could invest in somebody else's property equity and house prices went up, then what you're saving for your deposit would grow at the same price as the increase in the market. So there are all sorts of very interesting things you could do with tokenization going forward. And I think the world will get more innovative. But the point of legitimization really comes in if markets are a bit more stable, if there is more sort of legitimization, if there are more participants getting involved, then it's going to be easier for the man in the street to consider digital assets, tokenized assets, and crypto if they know that they can access it through the bank. Because, whilst it's great and exciting in the true sort of DeFi, DeFi genre is got some wonderful ideas and concepts. At the moment, the average man in the street, and I would imagine for many years to come, your granny's not going to log on to Uniswap, get into her MetaMask wallet, link it up, and then start buying and selling and investing. And then all of a sudden, oh, that looks interesting, but that's on say Solana. So now how do I get out of my tokens on Uniswap and Ethereum and buy some tokens in Solana? So it still requires a certain amount of technical knowledge and expertise and interest and capability that a lot of the population possibly won't get into. But if we want it to become something that's more omnipresent, something that everybody can access, then a degree of legitimization, and a bit like ETFs for large funds, if pension funds can start investing in crypto or in tokenized assets, through venues like ours, for example, then that makes it easier for people to adopt it. It makes it easier for people to accept it, and it drives regulators to accommodate it because, the rules are less restrictive to a degree for the institutions because they know what they're doing, are meant to, not always, but are meant to know what they're doing, and it's a little bit more buyer beware. You sort of come down further to allowing retailers to access assets and investments and so on. It is far more restrictive. So the more it kind of comes in at the top end, the easier it is to percolate down to the bottom.
I agree about that. Yeah, for sure.
Yeah.
It just gives me an idea of like, imagine the day when we'll be able to walk into a bank and buy crypto. We're not using. It's an insane thought, but this is the beginning of making that possible. I never even thought of that idea, but now it's like, maybe in 10, 20 years, I'll be able to walk into my bank and say, hey, can I just transfer this or just on my bank app instead of using an exchange, right?
Here's some Bitcoin, give me cash.
Crazy.
No, what I'm thinking? It's like it's a change of generations right now. Like to get back to Chris's point, the grandma, she won't bridge from Ethereum to Solana for sure. She won't even use the crypto. She's like, no, just give me to a bank. Not even the app, give me to a physical location. But to the little kid, let's think about it from the other perspective. There's a 15-year-old kid. He cannot even open a bank account yet, but he has some crypto and he's trading some meme coins. And he's experiencing DeFi already because it's very easy to use. If you've never used anything TradFi, then getting into crypto is easy. If you have used TradFi, it's so different that there's a learning curve. But if you've never used TradFi, like in this example, 15-year-old kid, and he's trading some meme coins, and now he becomes old enough to open a bank account, and he comes in, wants to transfer some money, and he's like, wait, what do you mean you don't work 24/7? Wait, I have to wait through the weekend? Like, what are you talking about? Like, I sent some money an hour ago. Why is it still not in my account? Well, it's 3 to 4 business days. What's a business day? You know what I mean? So there's that change of generation that will happen, but obviously we're like 10 to 20 years away from that, if not even more. But when we're talking about the retail investor specifically, it is going towards crypto because it's just making everything so much easier. The pain point is that it's so unregulated, so full of scammers and people who want to take advantage of this being unregulated, and people creating meme coins just to rug pull their audience and to find any way possible to get some easy money. Well, all of that will be purged. All of that will fade into obscurity over a long enough period of time. That's where I see everything going. But as far as the institutional investors are concerned, their liquidity is always going to be in the banks. And if you trade volume, and if you have like very, very big volume to your disposal, you're not going to have self-custody of that. You're not going to risk forgetting your password of your wallet or your security keys or whatever, you know what I mean? So when we're talking about the volume part of things and let's get to some real infrastructure talk. Can we talk a little bit of size? Because I saw something regarding your fiat transaction volume, Chris, on DeFinity. You guys are already doing quite well. I don't know if the information that I got is correct, but I saw something about 1 trillion in volume in fiat. Is that correct?
That is what we have traded through DMA Link, our sort of FX platform. But effectively, what we're creating for crypto is, and a subset of that is directly linked to the crypto side, the on-off ramping. But that is, so one of the things that our operating model did was, if you're a hedge fund or an asset manager or a bank, and somebody rocks up and says, hi, I'm sort of, say, Bybit, for example. Yeah, I would like to start, trading with you hundreds of millions and billions in this new asset class. And the manager looks at them and says, well, who are you? So who are your owners? Who's your regulator? Who's this? Who's that? And it's kind of like, well, yeah, no, it's okay. We're fine. We're regulated by we saw one for one of the exchanges that wanted to do some work with us. And, we have very high hurdle for selection, obviously, because of the parties we're dealing with. And this exchange came along and said, oh, we'd like to deal with you. Here's our regulation. And it was from the Ministry of Aerospace in Kazakhstan. And I said, It's not a financial regulator by the sounds of it.
What?
To me, that sounds like you found somebody you know who's a minister at some point, somewhere in a government that would, for a consideration potentially, this is clearly not an accusation, purely a hypothesis, but potentially sign off a regulation for you and say that you're regulated. But really, is that, is the Ministry of Aerospace in Kazakhstan a credible place to be regulated? I would say that doesn't have much to do with financial services, at least not as we know it. I think what is very useful and what has been very helpful for us, because we've created something that looks similar to the way financial institutions are used to seeing things, and actually because a lot of these big institutions already do business with us, and the trillion foreign exchange, they already understand us. They know how we do business. They know we've been around. They've been trading with us for a number of years anyway on fiat and traditional financial assets. So therefore, what we're doing is we're not bringing to them a new offering. Yes, we have a different brand for crypto than we do from foreign exchange, but ultimately, we're bringing to them a new asset class, a new product to sit alongside what we already do with them. And I think that's been quite key in terms of being able to have credibility and traction, because they know we understand what we're doing because they've been trading with us. They know we understand how TradFi markets work because that's where they currently trade with us. So therefore, what we've created and what we've brought to them, it ticks all the boxes that they need to tick. And they know that it does because we're already doing it with them in another asset class. So we're just adding a new asset onto the side of what we're already doing. And, we found that to be incredibly useful for us because it kind of brings that sort of, air of credibility, for want of a better word. And, during our time, apart from the FCA, apart from the European Central Bank, CBDC team, we've also had direct engagement with the SEC and through their FinHub, which is their kind of innovation. It's not a sandbox. It's I have to love it with the good old US of A. They basically have a department that will write you a letter that tells you that if you start trading in the wholesale markets under the structure you've gone through with them, that they promise not to sue you day one and shut you down. It doesn't say what they're going to do in day two. It just says that you start it, you're okay to start with. But if it goes wrong, we still may come after you. So, but it's as good as you're going to get. So we understand that their approach to their approach to dealing with things is slightly different from, say, the sandbox approach. But no, we've actually found over the last year and a bit the interest, and we talked about sort of the president and his meme coin and everything like that. But sort of all jokes aside, I think there's a far more bipartisan approach to crypto and digital assets and regulation. So I think before it was quite polarized. We've heard some very sort of senior Democrats say to us directly, listen, guys, we know that if we don't open the door to crypto, then, irrespective of whatever the Republicans do, we're kind of holding ourselves back from a huge swathe of the population because the wealth creation and the opportunity in crypto, a lot of people see. So standing in the way of that is not going to help us and is, going to keep a certain part of the population firmly away from us sort of through the next election cycle. So, we see the US pushing forward in kind of all fronts as well. And from our point of view, let's face it, the more the big powerhouse economies get behind crypto and the adoption of crypto and the ability of institutions to enter into that marketplace, the more that's going to accelerate the growth and the way they deal with things. And they're stopping to ask some of the questions. The best question I think we had at a round table, and it wasn't even from a member of sort of the FCA, it was from one of the other people that was there at the initial round table. They kind of said, well, okay, now one of the questions we're going to address is how do we regulate DEXs? And I was kind of like, what do you mean, how do you regulate a DEX? And they said, well, and from their point of view, they couldn't understand the concept that unlike a traditional centralized exchange, they couldn't control what happened. So like the London Stock Exchange, it's regulated in the UK, fine. I was like, okay, but you might have somebody in Brazil doing a trade with somebody in Kenya.
through a decentralized exchange. So I said, at what point in time does the British regulator have right to oversee or to regulate that transaction? Because it doesn't touch the UK. So, you've got to understand what you're dealing with, and education and the ability to help people create guardrails around, localization of transactions, or people acknowledging that they're stepping outside of regulation and sort of ticking the box that says, I understand I'm stepping into the big bad world now, so I may not have my transaction protected, whereas if I'm in the UK, I may. These kind of concepts are now starting to get to the regulators globally. They're starting to understand some of the differences in blockchain and crypto. And, they're, again, to your point, they're talking about, how do you regulate tokens? Is it a tokenized real world asset? Is it a meme coin? Is there any provenance to the project? Is it a utility token? Is it a security? Is it a quasi currency? Is it an investment instrument? So I think the initial one size fits all and we don't really know what's going on has dissipated. And I think that's key to being able to roll things faster forward.
Very cool. Very cool.
I think some more things that we wanted to touch on really quick was or just to switch gears, was some of the stuff that you guys are building, which is really, really pretty cool and absolutely insane. I mean, you guys got crypto repo, first of its kind, a gaming repo with Bitline, leveraging crypto for casino liquidity, and AI-powered anomaly detector and market making, which is absolutely insane. I mean, just keeping liquidity in the market. Can you touch on that?
Oh, look at Shakes with his research. Love to see it.
Yeah.
Oh,
Great question. Great questions. Yeah, so a lot of these things started with us, as we understood more about crypto and blockchain and how it worked. And, our kind of enthusiasm and knowledge around it grew from being users as well as observers and kind of passive participants. As we started building bits of the architecture and the infrastructure and kind of launching tokens and so on, we recognized that there were certain flaws and certain areas in the system that were kind of impeding its adoption. So, for example, the anomaly detector, Axiom, our AI partner that we've known for a number of years, we worked with them to create an anomaly detector. The reason we did it was initially because we know institutions need risk management tools before they can invest in an asset class. But because of the way crypto's, one, very high volatility, and two, a very fragmented marketplace, so there's no easy way of price discovery or mean price, then we knew that the banks wouldn't be able to use their traditional risk tools to try and measure the risk in the asset. So therefore, they would stay away from them until they could quantify the risk. So the anomaly detector really uses some very smart kit that Axiom use in a number of markets, including a lot of TradFi markets. But it's unsupervised machine learning. So very simple terms, it looks at what's happening across all sorts of different markets, so not just crypto, and then learns how movements in certain markets drive certain movements in crypto and gives a score that says, okay, this asset is likely to be more or less volatile than it was before. And here's the score as to how certain we are that this is going to happen. So it's non-directional, but basically it's kind of a volatility indicator for the top dozen cryptos. That helps banks understand and asset managers understand the potential risks in the portfolio they hold, which then helps them manage it, which is quite important to adoption. And the traditional banking tools that are used for risk management tend not to be able to deal with crypto because it's ultra high volatility and there's no single source of price from the market. So that was one of the things that we sort of looked at. We worked to create the market maker for centralized exchanges for projects. So we didn't have a great experience with a number of market makers with our own token. And, in the Wild West days that were sort of 5 or so years ago, there was an awful lot of collusion between VCs, between market makers. The behaviors of market makers were less than scrupulous. Some might say in some cases that is still the case. So we created something that both we could use ourselves and also other kind of blockchain and crypto partners and participants we were working with could also use to try and help remove them from the unregulated and less scrupulous side of the market making community that, as you mentioned before, there are little dark pockets where people crop up and there's kind of information asymmetry, and they use that to make money out of people who don't really understand what they're doing. So again, we created that.
Like the president.
Yeah. So from our point of view, it's very, very much about, we can either sit here, build what we've got, and then, like sitting in a boat and wait for the tide to come in to float the boat, and then off we go. Or we can work with, our partners, we can work with strategic partners and other participants in the industry to actually help build out the ecosystem that then means we're kind of all dragging the boat down to the water together, and we can actually start sailing faster. And that's the approach we've taken. We've not just built what we do as a core business and then waited for everything. And things like the crypto repo, again, are just a way of, a bit like ETFs we're a way of increasing exposure and adoption and profile to institutions of things like Bitcoin, and also helping the Bitcoin hedge funds, investors, etc., raise liquidity in a more secure way, rather than having to go to some of the kind of crypto lending pools that exist, which haven't always sort of performed spectacularly well or potentially provided liquidity when people needed it. And again, that's the same with the gaming repo. All these things are really just how we see the crossover between real market, the traditional real world markets and the new digital markets, how there are kind of products that sort of sit between the two that accelerate that adoption. And really that's sort of been in our kind of DNA from day one, was to try and bring as much as we can to the market, because ultimately the faster the market grows and develops, the better it is for us, but also the better the benefit it brings just overall. It's going to establish it. And I think it's a really exciting time for sort of blockchain and crypto. If you look at stable coins as well and on-off ramping, you look at things like, the payment systems, etc. And the one thing that we've not quantified yet, nobody's really talked about, apart from maybe the Bank of International Settlements wrote a report on it a year or so ago, was really that if you look at the way blockchain and crypto work, and then you apply that to tokenized assets, so bonds, equities, whatever you sort of are interested in, you look at the amount of collateral that sits around to support all these different transactions. So the simple example I use is very much about, okay, say I'm an asset manager, I'm selling an Apple stock and I want to buy a Mercedes bond, yeah? Then I've got to sell my stock, I've got to wait a day or two till that comes into dollars. I've then got to take those dollars, I've got to swap them into euros. That's another couple of days, because it takes institutions 2 days to transfer our currency. And then once I've got it into euros, I've then got to wait another 1 to 2 days to buy the European bond for the fixed income investment in Mercedes. So every stage of that process lives in a different ecosystem, has cash tied up just supporting the risk of failure of delivery for each of those assets. Now, if you put that onto blockchain, you can release the cash that's tied up, because you have transparency, visibility of the assets. You've got contracts, etc. you could use to ensure that if there's no delivery, there's no payment. And a smart computer can take you across those liquidity pools all on blockchain on a T+0 settlement. So you can do that trade today rather than sequentially about 5 days, and rather using 3 different banks' balance sheets and a couple of clearinghouses. You can do it today. And that then means all the capital that's sitting behind the scenes as collateral and security against failure to pay can get released back into the economy and back into the monetary system and actually do something productive. So it reduces the frictional cost of the trades, and it increases the amount of capital available in the economy to be productive. So we just think there's an awful lot of exciting things happening in that whole world, that, and what that does for the big funds, like I've said before, what it does for the big funds trickles down to enable the retail investors and the entire community, the entire population, to be able to benefit. So, yeah, we're super excited about the future for for everything that's happening, and what it does for trade and for all sorts of things, not just even from an investment perspective.
Yeah, I'm thinking that people who are listening to this now, it's like, but this is, for institutional investors. So how do I benefit? A lot of people are going to think about that. And, I just kind of want to give an answer to the unasked question here. So the way I always saw this is that, like specifically for crypto, right? The tokens would represent the company or the project, like the equity. And that's sort of how it started back in the day. And then it lost its meaning somewhere along the way, where projects and companies like yours are doing really well, but then it's kind of not really represented in the value of the token. I think that's something that's going to kind of level itself out over time, because that's how it 100% should work. So, for example, you have your token, DEFX, and in my opinion, that should literally represent the company equity that's right now, it's live, it's tradable. As you said, it's on Max C, but it's also on DEXs. It has a finite supply, and as the company is growing, so should the market cap of the token, giving value to all the holders. And I think that's kind of where, DEFX, your token, comes into play for people who like what they hear, who are bullish on the future of the company. And in my opinion, it definitely fills a gap that needs filling, which is everything that we have talked about so far, right?
That's a great point. I mean, one of the things we've noted, if you look at the adoption of new technologies by large financial institutions, what tends to happen is the guys that come up with the technology, the big financial institutions, the early adopters, they make it work to start with. And what happens is the big financial institutions say, we're going to use this kit. So they come away, they pick up the toys, they buy them off the market, and they take them off for the big boys to play with. So therefore, the people that started the whole concept tend to lose out. And the ability for other people in the kind of the retail community to benefit from the growth and adoption of that gets lost. So, we like to think that although we're working with institutions, and we're not delivering a retail service, actually access to our token is a way where people on the retail side can participate in the adoption of crypto and digital assets into the institutional market. Now, the very interesting point you did make was around the representation of equity. So our token is structured as a utility token. And the reason we chose to do that was because we didn't want to be caught in a sort of endless wormhole and money pit of creating digital equity. So we launched just around the time where there was a determination between a token being security or utility. So utility tokens were okay. Security tokens were regulated like equities. So therefore, effectively, you needed banks and lawyers and fields of people and millions of dollars to take them out into the market. And we genuinely didn't believe it was good value of money that we raised to put all that into just paying for a massive legislation arm before we'd even built out anything and we demonstrated that it was going to work. So we took the route of going down the utility token. But what we continue to do, and the point we're at now is, the buyback side is just started. So all the core and also ancillary services that we provide, so like the anomaly detector, the market maker, all these suite of services, we have created and continue to create new engagement for our token into the utility of those parts of the business. So people can achieve discounted fees by holding a certain number of the token. Now, as the regulation clears, that hold and burn balance will be able to determine a little bit more easily. So things that are very, very clearly pure utility and where people choosing to pay fees for, say, access to the market maker. So someone wants to pay their monthly fee in the market maker, they pay in DEFX, they get a discounted price. And because we can write it into the contract, a certain number of those tokens can be burned. For participants on the venue who are trading with us, if you hold a certain number of tokens and we have visibility of those tokens, as an institution, you can achieve discounted trading fees. So it's not even actually creating that saying to the institutions you have to invest because we think, this is a great investment opportunity for you. It's actually simple arithmetic. They say, okay, if I buy this many tokens, I get a discount to my trading fees. I'm going to do this much volume, so that discount is worth X, and I've paid Y in tokens. So as long as X is greater than Y, then I'm quids in. So what we've done is we've worked hard to try and create buy signals for our customers to buy the token. So as all the different streams of our business go live and ramp up, then there are more institutions and all our customers will be asked to go and buy tokens to create the buy side that will obviously create the upswing we anticipate in price because of the buy pressure coming in. And these people are looking to do it. And one of the important points we also worked with, so both Fireblocks and with Utila, was to make sure that our token was also supported by these institutional custody technology solutions. So again, DEFX is by far and away the smallest cap token that either Fireblocks or Utila support. So they don't support a lot of the MEXC, but it means if I'm a small hedge fund and I want to get a discount to my trading fees and I'm using Fireblocks as my custody solution because it's institutional grade and I don't trust MetaMask and I'm not going to kind of put it in on a nano and then put it under my bed at the end of the day. So if I want to get a discount to trading fees, where do I buy the tokens? Well, actually, if I buy the tokens, I can now warehouse them alongside my Bitcoin, my Ethereum, my Solana, whatever, in my institutional custody solution. So one of the reasons that was important for us was it eased access to these institutions to buy the token because they know they can hold it in custody alongside their other tokens on an institutional grade platform. So, we worked hard to deliver that because that was we felt one of the key motivators for people being able to access the token. So they see the economic value, but also they can buy it in the marketplace and they can hold it in their own custody solution. So again, they don't have to make an exception for our token. So again, that's one of the hopefully reasonably unique things about a token of our size cap-wise versus all the other tokens out there, and the way we've approached to making that token accessible and have utility for institutional players and kind of creating the sort of symbiotic relationship with the growth of the company and the value of the token.
Well, it's really the smallest market cap token that is available to regulated institutional investors. I think that's a correct thing to say at this point. It's so interesting when you put it that way, right? But I do want to ask you, while we still have you here, is there any alpha you can drop for us regarding to what are institutions mostly excited about right now? What are they buying? Where did their eyes go toward which chain, which coin, which token? Is that something you can share with us?
Yeah, so obviously we're seeing a huge amount of on-ramping, so that's no great surprise. And that's partly the acceleration of the adoption and so on. But when the money comes on, where does it go? Institutions are kind of curious beasts in as much as if you ever look at the way they measure a pension fund, it's like they talk about quartiles rather than outright performance. So you can be a top quartile fund, but you can still lose half your money. And that still makes you've lost less money than everybody else, which still makes you a star performer. I've always found that quite kind of odd. So it's a relative benchmark rather than an outright benchmark. But anyway, I think the institutions are still coming into the big tokens at the moment. Now, there is a lot of talk about sort of Bitcoin and the potential for waning institutional demand for Bitcoin, and maybe the fact that Ethereum seems to be as a layer one has become one of the most supported and most adopted by financial institutions platforms. So we're aware there are big projects out there, and a number of them are working with BlackRock or Fidelity or Aberdeen Asset Management, whatever. We're aware that there are a lot of pushes towards other kind of chains, but it feels at the moment like Ethereum and what they have as a functionality, and where they have got to in terms of adoption, means that because of its utility and the way it could be used to support financial infrastructure, that it could become increasingly important to wholesale markets, financial institutions, as common rails that people use, which would therefore drive up the adoption, the use, and the value. So we're seeing the start of monies trickling out of, say, Bitcoin, which is obviously the highlight asset, and also a little bit of a recognition of the difference as well. And without sort of saying good or bad one way or another, people are also starting to stratify some of the tokens in their kind of own approach. So which tokens are providing utility and are providing architecture, and therefore something that I will use, and it's my use of that drives the value, versus perception of value or scarcity, which may be more towards, say, the Bitcoin concept, where people are saying, okay, well, forgetting all the technical aspects of it, actually, as an asset, it appears that this, lots of people refer to it as digital gold. So therefore, from that point of view, I will invest in it as an asset for its own value, rather than what it necessarily does is something I use. Whereas a lot of the other, Ethereum type, layer ones that are providing functionality, and you can put Solana and other tokens like that in there, are also being purchased, and the value has been driven by the adoption and use. So I think there's a little bit of a rebalancing there, where people are maybe moving slightly out of this kind of Bitcoin value of asset and starting to diversify portfolio. But again, it's going to be driven over a period of time, rather than sort of an overnight short-term adoption. If you do, however, go along and you're interested in the token, and you talk about sort of alpha generation, we do have a Telegram channel on a daily anomaly detector for the community, and it's not investment advice, and it's definitely not a recommendation, and we spend an awful lot of time making sure that we don't speculate in the future value of our token, or indeed any other token, because it's kind of regulated, in a regulated position. We don't want to step over into becoming investment advisors, which is what we're not regulated to do. But again, people do look at the anomaly detector and look at some of the signals, and that helps them think about their positions and how they feel about the positions that they're in. So if it's looking very volatile, they may decide that they feel they're reaching a natural top in certain assets. If it's looking very stable, they may feel that they might want to hold their position a little bit longer and kind of take some of the excitement out of the ride. So, it's kind of there. It's linked in from our homepage. It's on Telegram channel on the daily basis, and for people who hold a certain number of the token, then they can access the early beta as well, which kind of gives a little bit more information. So yeah, I think hopefully that will provide a little bit of color to some of the future bits in the market. And as an old economist I once worked with at a bank once said to me, he said, look, I'm going to tell you what I think, but he said, ultimately, if I was always right, or even right half the time, he said, I wouldn't be standing at the end of a dinner table speaking to you. I'd be sitting on my beach.
That's right.
That's so true. Like I could give you financial advice, but it's like if I was right all the time, I wouldn't be talking to you.
Yeah, exactly.
So you choose if you want to trust me or not. Yeah, up to you.
Yeah.
No, but it's interesting with the institutions coming in so big in this cycle are we going to have the same cycle as always? That's something that we talk about. I don't know, you've probably been around crypto for a while. That's something we talk about that, towards the end of every cycle. Oh, this one's going to be different. But then this time, this one really is different. Like it's been different since the beginning. It's different now than any other cycle has been. So I don't know whether this cycle is going to end in 4 months when every other cycle has ended. We always had 4-year cycles with Bitcoin and with the rest of the market as well, following the big boy Bitcoin. So whether this cycle is truly going to be different, because we have this influx of institutional investors and with the ETFs and everything else, altcoins have underperformed. It's no secret. In the last cycle this time around, and in this phase of the cycle, Ethereum already had a new all-time high, and so did many other altcoins this time around. Ethereum didn't have an all-time high yet. Altcoins, not even close. Don't want to talk about altcoins right now at all, actually. But yeah.
Yeah, but I think you can maybe sort of, if you think about, what we just talked about the adoption, ETFs and so on. So, people come into the top asset or the best known one or the easiest one to enter or to understand or the most talked about one. Yeah. And then they start to look at it, crypto, we sort of talked about meme coins, we talked about altcoins, we talked about utility tokens, we talked about security tokens, we talked about tokenization of, Pokemon cards, other kind of real world assets and not so real world assets. We talked about digital gold and Bitcoin and so on. I think also what we're sort of seeing this time is previous cycles, there was an awful lot of upswell where actually value creations, for example, in Bitcoin, enable people to diversify their portfolio because they've made some money in crypto, so they could then diversify into others that potentially had greater multiples, but less certainty. And a little less transparency. I think what we're sort of seeing this time is, people are starting to bucket different types of asset into. So people that kind of put money in meme coins are probably looking at it saying, okay, well, it's kind of feels a little bit like, going to the track and putting it on the nose of the one that's got the jockey cap I like the look of.
Exactly.
And it's kind of, if I'm in and out at the right time, that's great, but I don't really know this. I don't know what the team is behind it, let alone the substance of the token, the concept, the value, or anything.
I just want to see the ticker go up. I don't care about that. I just want to. I want to buy low and sell high. I don't care.
Yeah, exactly.
Buy high and sell low. Do it like me.
Yeah, that way.
And other people will look at sort of Bitcoin as more of a sort of commodity type approach. So because. And I know the guys in the Bitcoin community have been doing great things, and the Lightning Network and all these sort of things, trying to accelerate and increase the adoption and to commercialize it. But ultimately, I think people are still generally, from what I see, talking about kind of Bitcoin almost as like a commodity. Yeah. So it's, the value is the people's perception of value. We know there's kind of something there, but ultimately, a bit like gold that sort of sits in a vault. People buy or sell it because of scarcity value, various other things, but it's to agree a perception rather than utilitarian. This time, and I haven't done the research myself, but I'd heard anecdotally, I think in one research paper that they said the value creation in Bitcoin was outstripped by the increased supply of altcoins. So the underperformance of altcoin was just driven by the fact that people that were making their money in crypto, in Bitcoin and maybe Ethereum, one or two of the bigger, weren't creating enough money to cover the increased demand for all the new altcoins out there that were looking to try and raise funds and to grow their own market cap. So this time the cycle will be slightly different because it maybe didn't have quite the same sort of upswing, but then potentially, for example, projects like ourselves, other projects that are now starting, we're like to call ourselves a business now because we're generating revenue. We're not talking about what we're doing, we're actually doing it. But a lot more projects, I think, are kind of reaching that degree of maturity, and investors are becoming a little more savvy the way they would be in maybe more traditional markets. They're becoming a little more savvy as to what the substance is behind it, what the team is behind it. Is there any validation? Is there any external touch points? So again, I think it's that the market is starting to mature. The cycle may go on a little bit longer. Part of that could be driven by how much the market and the transparency and regulation around some other tokens increases to allow new capital to come in rather than rely on the crypto ecosystem capital. So getting fresh money in will help support any cycle. That's rather true, than just recycling money between assets. So this isn't really just about, okay, made a fortune in Bitcoin or made a fortune in Ethereum, took that money out, pumped that into, or some of that money out, pumped that into some altcoins, but it stayed in the crypto ecosystem. Yeah, this cycle potentially more is about, what the institutions are doing with ETF. It's about bringing a lot of money in from outside to increase the relative value of the crypto ecosystem, but then also investors becoming a little bit more savvy as to where they deploy it, and maybe the number of total kind of blind punts people taking diminishing. We like to think we're in it for the long run. We made it through the crypto winter, so we're still here, and the business is now a business. So we like to think that we are maybe one of the lucky ones. How long the cycle lasts will probably be a little bit distorted this time, just by the nature of new money coming in, which maybe increases capital that wasn't there in previous cycles, where the crypto ecosystem was a little bit more isolated and a little bit more self-reliant. So that could change it. My one caution and warning, again, for sort of everybody is, Gordon Brown notoriously said the boom and bust is gone. It never happens. Fear and greed always sort of comes there in the end. But I think people investing in real businesses and real projects and tokens that have real utility or strong value points will, even if there is price volatility, will kind of see through in the end. So, value investing will still have a degree of, a degree of relevance, even kind of going into the crypto, going into altcoins, because, like us and hopefully lots of other projects out there, they're now starting to do real things. And therefore, they will be there, not just because their price goes up in the short term, but they'll be there because actually they have moved from being an idea to being a project to being a business. And, again, that maturity will hopefully help bring more people in as well.
Yeah, hopefully. I mean, that's the idea, right? We have to grow. We have to grow as an industry. This was the logical next step to get the institutional investors involved. And then, what comes after that? We're going to get small countries involved, and medium, and then large and big countries. I mean, you can kind of say that they're already getting involved, but the president of the U.S. launching a meme coin, I don't really consider that being involved in the whole infrastructure kind of things. And
that helps get all of that money in, but
I don't really know. I think the only thing that did was get money out. Money from the crypto ecosystem that would have otherwise stayed inside. But anyway, he did launch that at a time when greed was very high in December. It was greed was like early January. Greed was very high. We were overdue for a correction back then. Anyway, it's all programmed, man. It's all programmed ahead of time. We have all we can do is observe and do our best. But anyway, as far as everything else is concerned, this kind of infrastructure that is invisible, is the foundation of everything that's coming. Whether you are a fund or building a protocol or launching a token, the back end stuff is what's going to decide who will survive and who won't over a long enough period of time, right?
Yeah. Absolutely. It's got to be, it's solid foundations. I think we kind of moved on from, we've moved on from kind of good ideas that don't quite work. I think now, the idea generation is super important because that kind of feeds the hopper. But I think the bits, the nuggets coming out the bottom, they're the ones where actually foundations are good and they're delivering value. And it might not always be immediately visible. it's whoever thought way back when, when Amazon sort of started, everybody sort of just had them down as a, was it Barnes and Noble or whatever the big kind of American brand was, but they just thought they were a CD and a bookseller, and they didn't really see that people were, they said, oh yeah, people read less books, so therefore a great idea, but what's it going to do? It wasn't. It was just a platform. It was a mechanism. It was basically the plumbing that enabled trade. It enabled commerce, and what you can't buy on Amazon now. So I think we'll probably see a lot of crypto and blockchain architecture go through this kind of approach. If they're good, if they build something solid, something that's robust as a commercial purpose, as a value proposition, then ultimately, yes, there'll be a bit of volatility, but a lot of these economic models are being rewritten or being morphed now, and I think that the true value of them will become more and more visible in the future. And I think it's a really, like I say, it's a really exciting time, because if it cuts out a lot of the frictional value in the back of wholesale finance and increases speed and transparency of financial instruments and financial transfer of value, of access to investments, it may start behind the scenes with the banks and pension funds, but ultimately they all want to push it out the front door. They want to sell it to kind of you and I. So it is sort of coming in a big way, and their money's just sort of getting this big behemoth moving. But when it starts moving, then it will be better for everybody, I think.
For sure.
Yeah, 100%.
Yeah, agreed.
Any final remarks, Nate?
I don't know. It's just a lot, and I feel like crypto needs a lot to get to the spot that we all want it to be. So I think what is Chris and your team is building here, it's what is needed. Crypto kind of started as this kind of decentralized, I want to be anonymous. But we're so much past that. It's 2025. People are, we're more mature in the space. We want to actually look forward and bringing that innovation to not only crypto, but bring crypto into the mainstream and the main, like the real world, right? We want to go up to our bank. We want to use our bank app, and we want to instantly buy, maybe I want to buy a fractional part of my neighbor's mortgage, maybe I want to dive into grabbing a part of his car payment. This is what we could be thinking about and moving towards, and I think we just need to take steps like this, gradual, but then snowball quickly over time as soon as it's implemented, and then things are really going to take off, and we'll see that trickle down to retailers buying in. The grandma who saw the meme coins taken off there, she's now, hopefully going to be a little bit more aware, because she can take her walker over, wait in line, and then, yes, honey, I'd grab a little bit of $500 worth of latest, I don't know, maybe it's whatever, right? But this is what we need to work towards, and it's a generational gap, significant for but it's just a lot, and I think that's what we need to work towards.
Going to the bank to buy some meme coins now. This is gonna be a
telling you, man. I'm telling you.
They can all go back to their retirement home and then be like, yeah, I just grabbed I grabbed pumpkin coin today because I like pumpkins. Like, okay, I don't know. It's just gonna be wild, because when I'm in the retirement facility, this is what I'm gonna be talking about. Yeah, I just.
Yeah, I mean,
so
that's
it's
one side of things.
It's a wild time to be alive. Yeah,
definitely. That's one side of things, to buy it as an investment. But there's the other side of things as well, where you're going to be using it as a utility without even knowing you're using it. It's just because it's more convenient, because it's not closed on weekends, because it doesn't have a market open. It's just open constantly. And then comes the whole part that we talked about in the beginning about tokenization of assets and fractional tokenization decentralization, which is something that's super interesting to me. Like what Chris mentioned in the beginning. You can't own a whole home, but you can own part of a home as an investment. And those sort of things are where crypto really shines. And there's no other way to do this other than using the blockchain technology. If there are other ways to do it, people will already be doing it. So that's something that's coming, and that's something that I'm personally, very bullish on, very excited about as sort of investment vehicles. But anyway, yeah, we talked about a lot of things today, a lot of interesting things. And to end it off here, Shakes, do you have any final remarks?
Yeah, I mean, like Nate said, it's the next step. We have to mature. We've been in, and I think in not necessarily a fetus, but we've been in infancy of crypto for quite some time. So to see some more stability, to see some more, we want to be decentralized, but we are decentralized, but we want some more security, right? So KYC and things like that. It'll definitely help. Get us to the next level of what we want to see in the crypto space. So I'm looking forward to it.
Definitely. Yeah. And now, finally, Chris, do you have any final remarks?
Yeah, listen, just great talking to you guys. Thanks very much for taking an interest in our business, our token. And yeah, it's great that there are kind of there's thought leadership and there's talking points like this out there to sort of help. We're only small, so we can only do so much. I guess if we were JP Morgan, we could kind of put a billboard in every street corner telling everybody exactly what we thought, but we're not. So we have to be a bit more sort of viral about it. And yeah, just really appreciate the sort of time and the questions and the interest. And yeah, hopefully some points resonate with the kind of guys out there. And yeah, like I say, we've got a community page and a whole community behind it. So people want to dive a little bit more into what DFX is and who we are. Then yeah, we're kind of hopefully open and welcoming rather than kind of shy and secretive. So I'd like to think people can kind of reach out if they need to.
Definitely. Anybody who is
absolutely.
listening and is interested in learning more about DeFinity and the DFX token, feel free to do so. We will have links all over the place where you can dive a little bit deeper and see what they're up to in the back end sort of things. As you can see, as you can hear, very transparent and very open to discussion, which is very good. And yeah, anyway, thank you so much for coming on, Chris. Thank you, Nate and Shakes, for coming on to help a little bit here with the hosting. Hopefully we made everybody's day a little bit better. If you learned something new or laughed a little bit while listening, then we did our job right. Other than that, thank you, everybody, for coming out, and we'll catch you all in the next one.
Thanks very much. Pleasure.